Hello everyone, this is Sam Wong from Finance Services Analytics Team LLC. I know a lot of people were really concerned about the recent market and with the rebound and think about what to do next and what are some of the stocks that put potential undervalued. And if you hear my previous video, I have recommended robots at a price of $25, which of course at the dip, they really going down to lower than like 21.12, and also and PayPal, which I recommend buying at $75, and of course now it's rebounded back to $85, and I'm still looking forward to be actually going to be rebounding higher for next week if the momentum continues to stay after having the Memorial holiday. So many people were really interested about Netflix, and the stock have been really hammered and have dropped recently significantly. And if you can look at it, really in 5-year high was $700, and $700 at that time is really coming through with the Squid Game, which is very popular Korean drama that you really increase a lot of subscribers. For those of you who don't know the company, just give you a very quick recap. Netflix is an American subscription streaming service and production company. You actually the logo really you can actually watch the video anywhere you want, anytime, and as long as you have an internet connection. And also, basically they have their own licenses and product content, include original programming. So, which is one of them again is the Squid Games, which they got an exclusive copyright to watch it. So you're not going to be able to find in Disney or anywhere else. The stock price is currently, if this year low was have dropped to 162, so which I actually suggest my friend to buy around when the price was trying dropping one day, they're crashing about 18% and they continue for a little bit. It was holding steady at about $200 level. At this point, I told my friend that he should consider buying it around 185, 175, in that kind of range. And today I have rebound but still slightly below $200. But obviously, this stock really have a potential if you look at it, hold on to it for long term, or if you think about just a short term 10% gain, it probably would be very easily if the momentum continues that Nasdaq going to rebound. And Nasdaq recently have hit hard in 12,000, which is completely reasonable to break through 11,000. So I've talked about a lot of things about Netflix, but before I go into more detail, why buy Netflix? I'm going to show you the graph of Netflix really quick, so just give you some perspective about how this company was about. When I did the research, I was kind of really surprising about this company too, because this is one of the stock that, just like Apple, if you have owned it and bought it really way early, you actually really well and rich. So the stock, if you bought it at 20 years ago, which is about 2002, the stock is actually like a penny stock. Is like about $1. So 4 times its growth 10 years later, which is about at 2012. You actually the stock, if you look at this, I have 10 year. It's about $7/$8. So you were actually, if you think about it from an $8 perspective, you get down to $700 in 10 years, right? You really growing like 7 times, which is very nice, right? So one of these stock is kind of surprising to me, but from that perspective, you may actually getting that wow. So I shouldn't buy this stock then because it's gone up so much. It's just crazy. Probably overvalued at this point, but not quite, because if you look at it in 2017, the graph, which is recently right now after the end of fourth quarter 2021, to start trying to decline because of a couple of challenges and losing some subscribers. And again, Wall Street is always looking to start 6 months ahead. So given the outlook wasn't looking as quick as gonna be, the basically stock market penalizes stock significantly, so it's what really dropping quite, really a lot if you look at it, this graph at the big picture, into perspective. However, if you look at the stock really where they at now, and they actually back to 2017 level, okay, but what does that mean? Here's an interesting thing, right? If you look at the number valuation, which is the financials, right? I can assure you that is a lot more attractive today than 2017. So if you look at 2018, which turned 2017 by even make less, the full year of that is actually came in $4.13 on earnings. While in 2019 growing $6. 2020 have an amazing year, so $11. 2021 not so quite, but it's still over $10, right? And now the recent projection of the coming year will be probably landed to about $12, which obviously the forecasted have to be making more money, so that's why it's a bigger number. So gives you that perspective. Also looking at balance sheet, which is what for those of people who are accounting know the number. This is very critically important. Looking at the strength of the company, and this is looking at cash and short-term investment. You can clearly see that in 2017 is only 2K. In 2020, which is a year where the Squid Games come to very popular and rose its stock to $700 higher ever, you can see that you're really growing 4 times, right? From a cash and short term. And then 2021 have a little pullback, but regardless, I mean, even if 2022, let's say this year, did losing some subscribers, I mean, the cash and short term investment is still going to be holding in a probably 5, which is, still, if you look at its strength, compare it, still double 2017. And then the revenue, you can also same kind of picture, paint the same story. 2017 is a 10, and then 2020, which is a very strong year, and 2021 is very strong. The revenue actually up to 30K, which is 3 times more. And the cash flow as well is from 2017, which was still at a negative cash flow, to 2020, the story turned around to positive cash flow. In 2022, possibly, yes, positive cash flow. So what does that mean? So given you the graph and this rationale just provided to you, with the company just like making more money, getting the financial strength, just like you work, you've been going to work for 5 years, so you earn money, you're saving money for 5 years. Well, definitely your financial position should be better off than 5 years ago, which in this case, regardless of the valuation of the price where we're at, which is $192, you actually technically seeing that your strength of financial is stronger in 2017, and 2017 will price of around $160, I think. So you can definitely tell you that the stock gonna be worth more than where they're at right now from that perspective I just provided you. And then given the numbers as well, they have pretty good cash. AR still have a little bit on the book. They have some debt, but if you look at the ratio, I mean, which is really attractive, the PE ratio 1866. So if you imagine that when the stock was $700, which is now 192, which is 3 times more, you're talking about PE ratio of 60x. Now it's 1866. The industry 26x. So even below the industry, definitely a very attractive number. PAC ratio over 1, which means the company will continue strong and growth exponentially, which is bigger than 1 times 1. For those who know mathematics, I know what it means. And earning per share, which is very important for the market where potentially hit a recession, or actually some company may face bankruptcy due to the interest rate hikes. This company definitely not going to face that because they have earning per share $10.46. They have been making money. The profit margin actually very amazing, which I'm going to show you the pictures really quick. So from a valuation perspective, they actually beat the industry. They were doing much better on the return on equity, return on asset, return on investment, return per employee. They are all bigger than industry average. You can see this gray area is all NFLX compared to this arrow, which is the industry average. So having said that, it's really a lot of strength, but of course they have challenges because you used to be popular in 2020 because of pandemic. People stay home watching, don't go to theater. Number 1, number 2 was at that time Disney haven't come into play, have their own streaming. Apple haven't come into play with their own streaming. HBO wasn't growing as strong as today with some new exciting episodes. So you have that kind of competition, and I think the management actually made some mistake regarding to the password sharing and actually trying to bring in advertisement right now, which have a lot of criticism. This is where the leadership and management make it very important, because one mistake can cost a company 20% drop of the market capitalization. Market capitalization, the calculation is number of shares outstanding times the price of today. That's market value capitalization. So if the stock was $700 and now you dropped it to $200, what that means is the company from a market capitalization perspective take a hit of 40% plus. So that's not a good thing. So everything, and also this company have highly largely held by institution, 78%. So if the institution, which are the ETF and investment fund manager, losing heck a lot of money, well, then you're just going to be part of it, right? So a lot of time they're really making smart investments. So hopefully they will make money. So other thing is, again, the number very interesting and very solid. NFLX expanded at $3 a share and sell 8.05 billion. You look at the graph that the cash flow continue to grow. Total revenue had tripled since 2017. Cash flow turned positive since 2020, which is something I already covered. The P ratio pullback, which is very much making a little bit more attractive. Operating margin is bigger. And also get to the last point too. Some research have been done on different review and company rating about Netflix, and the consensus analysts target 12 months of $290, which are upside 50% from this current price. And you really can tell this is, I'm not gonna give the name of the report company, but here's the comparison. He tells you the evaluation. Fair value really give the highest rating 5. The fair valuation price $227.83, which means at least 11% of where it is as a Friday market close. So there's still opportunity for short term if you will talk about that. But there's another other evaluation market analysts were given the rating 290 at the 12 months target, and potential really will gone up to 440. And you look at these numbers, which is really what I just covered, so really doesn't matter whether you see it or not. Is from a 2018 compared to 2021, pretty much you can see that the number is pretty much growing up, and the P ratio, actually, you look at that, 2018 was inflated as well, but right now with the prices go devaluing and take a hit so much, P ratio is really very attractive now at 18.8x. And the net income, actually, you can see that continue to be growing. Net margin percent also continue to be getting better in the future, still going to maintain 10% plus. In the book value, you can see that they actually 2012 were negative positions. 2017 is still negative position, but in 2020 they turned the tangible book value actually at positive, and earnings actually continue to grow. You can see 2012 at 5 cents, and today 2021 at $8.02. So payout, even though they don't pay dividends, so it doesn't cover that one, but but then again, they give you a very good insight about how operating this company is, and you can actually compare with the peers as well, which go over really quick. I mean, it really depends on how you look at it, but the recent month, just 1 month of the trend, I mean, the stock actually have quite a bit up, taking a hit, and actually you can see kind of have a string of rebounding back, same as Rockwool, but LGFL.A, which actually could be the pretty badly and still in the downward trend at the moment. Disney also have tried somewhat rebounding over the week and last couple of days. And it's just comparing, in this comparison in the industry, it's not quite exactly, but they compare Walt Disney, Rockwool, World Wrestling Entertainment, which I don't know why they're doing that one, but Lionsgate. You can see that obviously the 52-week change, which is the price taking a hit, is very severe. Netflix compared to Rockwool also gone down, lost 72%. But then all the stock pretty much down except this World Wrestling Entertainment. And then market cap, actually, in terms of market cap, you're very strong in, speaking of Netflix versus Disney, 199 billion. Beta right now, recently from one of the report, is actually 0.9, which is this number is not a reason. That means because of the growth of cash flow, they actually consider lower risk. So anything beta 1 is neutral, or anything bigger meaning has a little bit risk. P ratio will cover the revenue. They're pretty strong to 30.4 billion, and compared to other one, except this is 36.6 billion, which is bigger than them. But profit margin definitely is really rocking at 15% versus this only 4%, and the other one actually even have negative 3.9%. So and it was earning growth, which is talking about 5-year comparing. None of these four stock really can compete with Netflix. It's really actually the top notch and really best. Analyst reporting, just to give you the last piece of information again. The $290 and $440 was the really upside, very strong strength. So given that, meaning you will be actually have some surprise that subscribe continue to grow even better than where the operating environment was in the last quarterly earnings. And this is just give you a perspective of strength. So this is coming from one of the comparison where this asset class have bought various stock, and so Alibaba, Amazon, eBay, JD.com, Netflix, and Pinduoduo is Chinese stock. And you can see 5-year sales growth really. Alibaba actually is the leader, but Netflix is actually pretty strong along with JD and Amazon. But in terms of 5-year earning per share, however, Netflix actually is the leader. But Alibaba, despite a very strong sales growth, which is revenue, is actually not, the earning per share wasn't growing as well as it is. But JD also, which is in a competitor Alibaba actually did pretty well from that space. If you look at 1-year perspective rather than the 5-year perspective, you can see definitely that and the earning per share, Netflix is going positive 32.3, but again, bear in mind that in 2021, where Netflix stock have actually hitting the highest ever in the last 20 years, $700, okay? And Amazon actually negative 42% from the perspective. 12-month sales growth, Netflix continue to grow. Alibaba was also doing very well, and so does Pinduoduo, where you shine. Because one of the reason I'm showing you this graph is I also had covered Pinduoduo and some of the Chinese stocks, so this is, I think, give a very good slate of giving you some idea where my research and analysis and information coming from. So last quarter sales growth as well. Netflix is a 10%, Pinduoduo actually doing pretty well. So does Alibaba, but JD also, which is also a Chinese stock. They in the space competed with Alibaba and Pinduoduo as well. They were growing very, very well. And then last quarter earnings per share, actually Alibaba was the leader. And you talk about dividend growth. I mean, some of these stocks don't pay dividend. I won't give it that. But by price earning perspective as well, you can see that definitely Netflix is the leader again because it grew it to $700, which is really record high. Pinduoduo actually have hit $215 as well. So the growth was also amazing, but again, from $215 it wasn't very sustainable. Unfortunately, it dropped it down as low as $20, which means lost 90% of value at the very peak. But recently have actually support with their announcing Alibaba announced earning, which actually also reduction of the interest rate of 0.5% in China. It's actually made these high-tech stock grow, having a momentum again. So Pinduoduo have grown from really last month, the lowest point of facing a risk of potential delisting of $21. You got all the way back up to $45, which is amazing, which is actually give you 100% return in 1 month. So that's just the highlight one. And then we return on equity, which is very important in this slide. eBay actually did a pretty good job, but Netflix is 26%, Pinduoduo next 16%, which is also why I have been recommending Pinduoduo in the past as well. To recover that, Netflix is 80% institutional investors owning the stock. So if these ETF or institutional investor fail, then obviously, I mean, you follow the boat. Then I think it is what it is, right? And then from a debt equity perspective too, well, Netflix is quite a bit of debt. I don't know why, but they have 93%, and Pinduoduo only 24%. Actually did pretty well from that perspective. And eBay also have a lot of debt, 79. So just give you a very good perspective of how and why I recommended Netflix, and also Pinduoduo was my favorite in the past for those who know. And also I wanted lastly I want to also recommend a stock which I won't do a video because there's not enough statistics to collect. HYLN. Recently HYLN had gained another contract and increased the revenue, and they have cash to burn through the next 3 years should America really in recession. Remember 2025 is the green year, so they are very getting closer, and actually they're showing the growing improvement. They are going through SPAC, which is at the highest of $52. They crashed as low as $2.50, I believe, and now their momentum and fall for 350. I think you really will. I read the article that's supporting the 1 year target will be $4.30. I personally look at $5, and just similar to the story here and the Netflix and some other one like Facebook. If really the next 3 years the stock really can come through it, HYOM, then you potentially could be another Netflix, which could go back to $50, even $100 a share. So the other one, XPEV, but recently haven't do a lot of momentum and still losing money. Both of the stocks that you know. Tesla is kind of a little bit expensive, pricey, but bear in mind that they are trying to go through the board to get approval for another split. So that would actually, if you own the stock today, which is currently now a little bit pricey, $750, but compared to $1,200, just a few months ago, you bought it, you probably can wait for the split to take advantage of that. Hope you like the video. If you have any questions, feel free to send me an email. Have a wonderful Memorial holiday. Hope everybody happy and have a good health and spend great time with the one you love and your family. Thank you.